From the morning reading, the FOMC raises rates, indicates three changes for 2017. Stocks fall, bull flags are prevalent. Breadth weakened compared to the prior session as decliners led 2430 to 608 on the New York Stock Exchange and led 2080 on to 727 on the NASDAQ. The Fed raised rates as expected. It indicated it plans to raise rates three times in 2017. Stocks sold off following the announcement. The SPX was down less than 1% for the day. This expected rate hike and the three indicated for 2017 is a sign that the Fed is expecting the economy to stay strong in the face of rising rates. In other morning reading, the S&P 500 snapshot, the Fed rate hike mini tempest. Yesterday's record close, and that's referring to the prior day, in the S&P 500 was followed today by a fairly routine gaming the Fed session. Last December, the Fed announced the first rate hike in nearly a decade and forecast four more hikes for 2016. Finally, today they announced the one and only 2016 rate hike. The 500 traded in relatively narrow trading range, mostly in the shallow red until the 2 p.m. Fed release. When you look at the chart in both price and volume, the index experienced a not surprising mini tempest, hitting its intraday high at 2:04 p.m. and then selling off with a buy head fake to its negative 1.02% intraday low a little over an hour later. Subsequent volatility led to a trimmed 0.81% loss. The Fed didn't surprise, but markets moved anyway. For bonds, the dollar, and gold, the reactions to an increase in Fed funds target rate were among the largest of any of the 106 times the rate has increased over the past 40 years, usually leading to a reversal of the knee-jerk move over the short term. At least the Dow managed to trade at a new high. However, briefly, the Dow Industrials traded at a multi-year high in the past when it has done so on a day the FOMC announced their policy on interest rates. The index struggled over the next month. A day after closing at new highs, stocks suffered their worst breath in 2 months. That's a sudden change in character, but hasn't always or even most often led to a change in trend. Of the 15 times it has happened since 1962, the S&P did continue to lose ground over the next 30 days, 10 times. Over the next 3 months, it lost at least 5% at its worst point 7 times, but it gained at least 5% at its best point 6 times. Only 4 of the 15 ultimately coincided with a major change in trend. Just in time, investors flooded into index ETFs. The spider took in more than $4 billion, the most so far in 2016. Diamonds grew by nearly $550 million, also the most in a year. Fund flows are not a consistent indicator or a contrary indicator as we'd like to see, but when there is such a large inflow after a move like we saw heading into Wednesday, it's usually a short-term sign of exhaustive buying pressure. The Fed hikes as expected, but suggests more to come in 2017. Bond yields climb along with the dollar. Gold and rate-sensitive stocks lose ground, so do emerging markets. Stock rally stalls while in short-term overbought condition. Seasonal trend, however, remains supportive. The Fed offers a slightly steeper path for 2017. The Fed surprised no one by raising short-term rates by 1/4 point. It did, however, offer a steeper path for rate hikes in 2017 that may have caught more attention. Bond yields climbed, which boosted bank stocks initially. Bond proxies like utilities weakened the most. The dollar rose with bond yields, which pushed gold prices lower. Foreign stocks also weakened, with emerging markets suffering bigger losses. It's doubtful that the session's Fed announcement will change any market trends currently in force. It may, however, lead to some short-term volatility. The stock rally appears to be stalling. That's not surprising considering how far it's come over the last month. The 5-year Treasury yield climbed to the highest level in 5 years. The dollar index, UUP, drawing closer to another 14-year high. That combination is causing selling in emerging markets. EEM fell 2% after failing a test of its 50-day average. Some of that selling is spilling over into U.S. stocks. The Dow and the S&P 500 look stretched. The post-election rally in the Dow and the S&P 500 look stretched. The red line shows 14-day RSI for the diamonds peaking at a very overbought reading of 85. That could pave the way for a short-term pullback or consolidation. The chart also shows in the S&P 500, the spider, the slow stochastics oscillator forming a double top while in overbought territory over 80. The spider is also struggling to stay above its upper Bollinger Band. The NASDAQ Qs, having just risen to a new record high in a stronger technical condition, some money has started moving back into larger tech stocks that have lagged behind since the election. The Qs spider ratio is starting to turn up. None of these short-term signals is enough to damage the market's overall trend. Any short-term selling should be countered by a positive seasonal trend for the balance of December. Market uptrend was due for a breather. The Fed may have provided the excuse for one. We'll have to let the dust settle and take a closer look at how things look going forward. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:19 a.m. Mountain Time, and I am recording this in preparation for the market day of December the 15th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. Had a lot of morning reading there, but obviously big announcement yesterday, and we wanted to give some color to that event. As of the time of this cut, the U.S. broad-based indices were mixed, with 3 of them just below scratch and the Dow just above scratch. Crude oil also just below scratch. Euro's down, though, about 1.33%. Bonds are down about 0.5%, and gold has made a significant move, down nearly 3%, some 33 points on the gold futures contract in the overnight. Futures in China, I should say index in China, is down about 0.75%. Hong Kong down about 1.75%. Japan up just above scratch. Germany up about 0.5%, and United Kingdom also right on scratch. In terms of macroeconomic reports for today in the United States of note, you have CPI, Philly Fed manufacturing, weekly unemployment claims, current account, Empire State Manufacturing Index, and let's see here. Oh, nat gas storage. So we got quite a full slate, really. And looking forward to tomorrow, we have housing starts, building permits. So a couple housing reports tomorrow before the market opens. In terms of current volatility conditions, obviously we did see a little bit of a spike in volatility yesterday. Short-term VIX 12.84, skew just barely above the threshold to put us in a cautionary area for that indicator. IV percentiles, kind of very, very, very low, but still up off their lows. S&P 14, Russell 13, NASDAQ 22, Dow 16. Not any significant differences there. We did have standard deviation size moves put in yesterday on the spiders and the Russell, and I got a positive one here. Actually, that should be a negative one. I'll have to correct that. So -1 standard deviation moves put in on the S&P and the Russell. And then in terms of looking at the charts for today, you can see yesterday's action on the S&P futures chart, and that 2-candle combination right there is called a dark cloud cover. It is a bearish reversal sign, and you see thus far it is confirming with weak overnight action coming into the open, which is a a little over an hour away from now, so we'll see what all market participants do. But if they continue with this weakness, that certainly is a reversal pattern, kind of classic candlestick reversal pattern for a change in short-term trend. And others, we had, of course, a couple sessions ago, the reversal candlestick pattern. If you look at the RUT, it's more clear. With the 3 candlestick reversal pattern and island top, and that certainly did confirm and coming down more with yesterday's action. So you even got a Pearson's arrow signaling now to kind of confirm what the candlesticks had told you a couple sessions prior. So bottom line, looking for these reversal patterns. You've got one on the S&P, you've got one on the Russell. Look at the NASDAQ, and we had the big break of the area of resistance, and then we get, I guess we'll call this a spinning top, and then a little falling down from there. So at very least, a little bit of indecision after the breakout by the NASDAQ against the face of the weakness in the other indices. And then finally, let's take a look at the Dow, which has been relatively the strongest, and you have what looks to be a dark cloud cover here as well, very much like the S&P. So multiple signs of reversal patterns, which should be setting us up for a short-term retracement, exhale in the market. Crude oil also had big day yesterday, and after having popped way up to 54.51 and then retracing all that move within the same session, saw a big failure and back into the prior trading range. So this is probably quite a disappointment for the bulls on crude oil, that after such a big solid price action move way above the area of resistance, that it's so woefully failed and is now back into that trading range. So until all else is proven otherwise, we're expecting that trading action in crude will remain in the trading range. It has yet to be proven that this breakout had any legs to it. Though, of course, we could also get whipsaw action to the bottom side. We'll watch the next couple sessions to see, do we continue to respect this resistance area, or do we move back up and then clear the area on crude oil? Gold had a big overnight move, and you look at this, we continue to talk about not getting in the way of this strong downtrend in gold, and you see gold breaking down to about almost the 1125 area in the overnight, and it's so far holding much of that big down move. And let's take a look at the dollar. Look at this dollar, and I think one of the morning authors happened to mention that something like a 14-year, using the UUP ETF, a 14-year high on the dollar. So very, very big breakout of the consolidation pattern. So this is a horizontal breakout effort going underway here, and that dollar, of course, has big implication moves for markets like emerging markets, as well as we'll take a look at, here's emerging markets, big down action with yesterday's decision, and that rolling through the dollar and other markets. And then also, let's take a look at developed markets. Developed markets also took a hit with that. So basically, the U.S. went down, the developed markets went down, the emerging markets went down, dollar up, gold down, and crude oil down with yesterday's action. Let's take a look at bonds here. Of course, that's another one, much like gold we've been talking about. Don't get in front of this bearishness. You're likely to suffer a lot of heat if you do that, until we get a clear reversal signal and reversal pattern. That has not happened on bonds or on gold yet, or to the flip side, on the dollar. Everything is pointing to continuations of those strong trends. And then finally, volatility. Now, volatility, while we had this kind of uptick in action and price action yesterday, when it's all said and done, we're still in the noise zone for normal bull markets. And indeed, while there were retracements in many of these markets yesterday, the bottom line to it is, as we go to the daily report, is that this is an expected exhale. We've been looking for signs of reversal. Our sentiment indicators and other indicators have been telling us to watch for these signs. And whether it's the Fed announcement or something else that, ultimately gets the, in quote, credit for causing the retracement, certainly the market was looking for an excuse to have an exhale pattern, and that happened with yesterday's action. Big picture, though, we're still market phase 4, price patterns near resistance or extension patterns. That's bullish. And the 3 market timing signals, there's still strongly a bias to the bullish side. From IPD, confirmed uptrend, that's bullish. GMI index is still a perfect 6 out of 6. Buy signal in place since 11:10. And stock charts decision point scoreboard still very strongly bullish on the short term and 7 out of 8 of the signals on the intermediate term. Really, it's only the long term that still has these mixed signals. Position sizing models are both still at 100%. Intermediate term market posture is still an exceptionally strong bull setting, and all 4 of the indices. That is not changed with yesterday's price action. So that's also supported by an exceptionally strong bullish sentiment line. So retracements would be expected from a probability standpoint in this kind of market condition to be relatively short and not terribly severe in terms of how far they go. Overall hedge warning status remains a 0+, normal with some elevated conditions. Overall strategy opinion, still no changes after yesterday's action. Everything thus far is just simply what we expected, and really doesn't change the overall intermediate term time frame horizon, which is our primary time frame. In terms of specific areas of warning, in the volatility area, you did have some new warnings fire off. Market in decline, sharp increase warning fired with yesterday's action. But remember, put this in context. It's within a very, very low VIX, within that 12 to 15 window. So these are minor warnings. Obviously, if the change and rate of change starts to accelerate and we start to see diagonal, then horizontal support areas fall, then we'll pay more and increasing attention to these. But right now, this is just a normal exhale within a market that was frankly extremely overheated with a month of price action since the election outcome that was just almost parabolic, if not indeed parabolic in some of the individual markets. Distribution day count in the NASDAQ still continues to remain stubbornly high at about a 6. Skew, as I mentioned a little while ago, just barely went into the warning status. Trend-based, no new warnings here. Intermarket risk aversion indicators, no new changes here. Most of these are very tightly wrapped around each other, so we're really calling this more of a neutral stance at this point. Price action from yesterday did scrub off some of that sentiment, so you see short-term and intermediate-term more middle of the road. Though the fear and greed index still relatively high at an 86, anything over 90 is very uncommon. So probably need a little bit more of a pullback to scrub some of that sentiment off. One of the morning authors mentioned breadth, and certainly when you look at the sector-specific information, there are very few that were in the green for yesterday, and no sectors were in the green for yesterday. Information tech did hold up the best, followed by healthcare, and you see financials negative 0.60. The big losers of the day were those interest rate sensitive products. You have a lot of high yield bonds that are in the energy sector, so you see that impact there. Utilities, real estate with your REITs and so forth, being obviously very, very interest rate sensitive. So all this that was related to the interest rates, while it can be said that everybody was expecting the rate increase of some quarter a point for yesterday, perhaps the surprise is that the number of increases that are being projected for 2017, with 3 being forecast by the Fed. Now, at this time last year, of course, they said they were going to have 4 for 2016, and they only had 1, and it took them a year to get to that next one after the first one took 10 years to occur. So, the current expectation for 3 next year, we'll see. But bottom line, that's what's being communicated by the Fed, and that certainly reverberated and was priced in by these interest rate sensitive markets. So we're just over 20 minutes right now. Let's go ahead and roll through our wrap-up slides. If you see something of interest, just hit the pause button, go to the hyperlink for additional information. We're going to go ahead and hit the disclaimers. Disclaimers, as always. Hit the pause button if you need more time to review the disclaimers. Also note the hyperlink down here at the bottom for the full set of disclosures. We should be back next for tomorrow's market preview session from Falcon Global. In the meantime, manage that risk profile, and you should see that consistency. And then each and every day, seek to go out there and learn something about your trade craft, investing, and trading. Good trading.